6th, gas meeting, old business, Hound Resources, royalty 17,303. Do I need to do a motion for that or no?
No.
Okay. New business, approval of minutes from October 20th, 2023.
I'll move.
Support.
I can't, I'm not sure I can hear you.
We're, yeah, we can. We're just,
Have Doug wave his hand if you can hear me. I mean, we can't hear you though.
at it,
Let me just see why. So you can't hear us at all, Woody?
Obviously not.
Can you hear us now, Woody?
Yes, I can.
Okay.
Good.
okay. Go ahead, sorry.
I don't know where we were.
We were just going over
Approval of
Hound
minutes.
Resources.
Or the approval of minutes?
Yeah.
Oh, minutes, yeah. So,
Motion and support.
okay. All right. All in favor?
Aye.
Aye.
Investment advisor, update and commentary.
Okay, Woody, we're ready for you.
Great. Well, unfortunately, Brian Walker texted me early this morning, and he has a family emergency, so he's not going to join us. But we're going to go through the booklet, and then we have a couple of items. We wanted to continue that discussion about yield, and it's mostly fixed income yields, but maybe give some more clarity to how yield is quoted in our reports and the different types of yield. And then we're also going to give a little bit of a brief snapshot of foreign investing, because that's a component of the Manistee Oil and Gas Fund since the beginning. And it's been an underperformer, but we wanted to talk a little bit about that and give you some background, some insights to foreign investing. So I'm going to see about. Now, does everyone have the booklet in front of them, or should we try and screen share?
We've got it.
We've got the booklet.
Oh, okay. So should we just stay on camera here?
Yeah, that's probably best, Woody.
Okay, good. Okay, well, we'll start with, the usual, overview of the economy and the capital markets, and that's on page 4, which is titled Bartlett's Market Assessment. And it's fair to say that about 3 months ago, there was a dramatic change in the markets because shocking most advisors was the development that we've got a good economy and low inflation. And I think the consensus opinion of investment people was the only way we're going to get inflation down is through an economic slowdown or something like a recession. And the economy is doing just fine, and inflation is getting down closer to the target zone, that 2 to 3%. And so we've got what's really a fairly strong economy and low inflation, and that's a really rare set of circumstances. I think you have to go back to 1953 to see where you had full employment and inflation kind of in this range that we have now, and that was fairly brief. Since then, you had slowly creeping up inflation and or higher unemployment. So that's pretty surprising. And so you've got really the best of all worlds for stock and bond markets, and you've seen how the markets since November, when this inflation report came out, it responded accordingly, and stocks are up 15% or so, and bond yields have gone down. So it's been a really excellent environment for investing. And we have some of that on here. There's still a lot of indicators, surprisingly, that indicate that we might still have a recession. I mean, leading economic indicators sort of ticking up in jobs available, the purchasing managers index. The yield curve is still inverted, which means short-term interest rates are higher than long-term interest rates, which is typically an indicator that the economy is going to slow down. Housing has kind of been slow, but all things considered, it's a very encouraging set of circumstances right now. So, any questions in terms of the overview of the environment for investing?
No.
Okay, well, let's go on to the next page, and you can see this relationship between stocks and inflation on this page 5. High inflation has been moderating. You can see last June when inflation hit at a 9.1% annual rate, and the markets were in panic over that, and they had been in decline, and then they declined further over the next month or two, and then lo and behold, around September, you see that the inflation rate came down to 8.2, and the markets thought, hey, that looks good. Stock market started to go up, and then it's gradually been dropping 6.5, 6.4, 4, and the market keeps going up. And then you had that spike in November where the Standard & Poor's 500 hit 4,194, and now it's peaked up something closer to 4.9. So it's been a big rebound. I think I don't know if we need to spend too much time on some of these other charts. I'll turn it over to Troy, and he might want to make some brief comments. I think on page 6, I think most of you know that it's people under 40 or under 35 that think these rates are high, but I think there's some wisdom in the room that knows that back in the 80s and prior to that interest rates were much higher, but they're actually about average. If you look back over that 50-year period, they're kind of back to average. They're not really high. And then I'll let Troy pick up on the next page, which is the change in the Fed funds rate.
Yeah, thanks everybody. I had to join Woody. I was having trouble with my audio in my office, so forgive me for encroaching on Woody's screen here. But you're looking at this page that shows the history of Fed cycles. Oh, yeah. And so this current cycle on this page at the top there, you'll see has kind of gone flatline, where the Fed's been on hold for several months now, and during that time has gradually shifted to, from rates are going to be higher for longer to more recently now, when will the next rate cut come? And so we've kind of moved into maybe a maturity of this cycle. When we look forward into the rest of this year, the Fed funds futures are indicating that the Fed may begin cutting as early as March or May, somewhere early part of the year. And then there's a lot of debate of how many cuts will happen this year. And of course, the strength of the economy, how inflation unfolds, all those things will have an impact. The market is pricing in 5 or 6 rate cuts, which is pretty aggressive and typically would be associated with more of a problem economy. And we're having quite a good economy right now. So on the other hand, the Fed is, through their projections, are expecting to cut rates 3 or 4 times. So there's a big gap there between what the Fed is signaling and what the market is expecting. So the market, I think, thinks there could be reason that the Fed would want to push a little quicker to bring those rates down at some point later this year. But this is, the whole point of this picture just really puts it in perspective historically, how some of the other periods when the Fed was raising rates, how much more aggressive this was. So it wasn't surprising to hear so many economists expect a recession last year, because that's typically what's happened when the Fed's raised rates aggressively. Possibly the extent of all the stimulus that we got during the pandemic has prolonged and made consumers more resilient, which we just saw. We saw very good spending by consumers in the fourth quarter, better than expected. And, but there's still fear that, the average consumer's, borrowing more. Some of that stimulus is wearing off and not in their savings account anymore, and that there could be a slowdown later this year. So all that factors into expectation for lower rates on the horizon. I'll let the next page is something we like to keep an eye on, leading economic indicators. And so this goes back historically. You can see in the gray, those gray shaded areas are recessions. And one of the benefits of this chart are that it tends to highlight slowing economic growth. It tends to catch these recessions. And if you look in the circle there, the recent downtrend has been pretty steady for over a year. So, with the Fed raising rates and things like, mortgages, home sales dropping off, all those factors, which are highlighted in that box, have turned that indicator negative for several months in a row. And again, typically you would see maybe a bigger slowdown by now. You would see a recession even. Maybe that's still on the horizon. So, everyone's kind of keeping an eye on this. And for the moment, with the way the economy's been acting recently, people who are in the soft landing camp, I think are having, more of it their way than the camp that would expect a recession. So looks like so far so good, in other words.
Let's skip ahead a couple pages.
Woody, I got a question about rates. So
Yeah.
there's a lot of people that still think a recession's coming, which means interest rates will get whacked lower. There's some that think it's going to be a soft landing, which means it may take a little bit longer. But are you guys locking in some of those higher yields on the 10 years and some of the longer corporate bonds in anticipation that rates are going to go down here relatively soon?
Yeah, that's right, Ed. Just looking back at our recent purchases in early January, we bought 5 bonds, and all of their coupons are over 4%. We bought a Treasury note with a 4%, an Amazon bond 4.70, Netflix 4 3/8, Smuckers 5.90, and a mortgage, a Freddie Mac mortgage that pays 5% on its coupon. And those are all longer bonds that will be in the portfolio for a while. Yeah, there's more we can do. Part of it is trying to not take too many losses. I think taking some occasionally are okay. And maybe feedback from you would be helpful there. We could certainly sell bonds and take losses, but generally clients don't want to do that. But it's not all bad. If interest rates do fall, the bonds that are at losses suddenly become bonds at gains. So you get it back if interest rates drop. But you're absolutely right. Quarter in and quarter out, we're trying to rebuild the portfolio after all those years sitting at low rates and introduce higher coupon bonds as we can, and try not to take too many losses. Usually when we buy bonds, if we sell a short bond, we buy a little bit longer bond because you have to do that to keep the interest rate sensitivity in the right range. So that helps.
Thank you.
Okay.
Any more questions before we move on?
No.
Okay, well, this page 10, Magnificent Seven, just points out that this market has been very oriented toward these top 7 companies. You can see it's listed across the top. I think most of those numbers, those symbols are familiar, but they haven't listed there next to the chart below that. This chart actually is a little deceiving because it's looking at the average performance, a weighted average, where actually the stock market last year was up about 27%, and about a big part of that, maybe 20%, 21%, was in these top 7 companies, and the rest of the market was only up about 7. So it just goes to show that it's been a market very dominating by these top 7 companies, and unusual that you have to own these, and we do. Fortunately, we own several of those. We have a number of those, so it's worked well for us. But it's been a market where you, in order to be in the game, you have to own these companies. Let's skip ahead another couple pages, and this one is interesting because it just shows that on page 12, political parties, that going back over time, some investors might think, well, during Republican administration, markets do better than it does Democratic administrations because Republicans are more business oriented and policies more favorable to business. But if you go back, that correlation really doesn't, there's not a good strong correlation there. So it's kind of interesting. Any questions so far?
No.
Okay. Well, why don't we take a moment and go back to this yield? Jeff, you had a question last quarter about yields on the report, and there seemed to be some, misinformation about the report in terms of what the yields are. And I'm going to turn it over to Troy to kind of help clarify that for you.
Yeah, I'll just maybe go back to the yield to maturity first, Woody. So I think, from what I understand, that some of it's right here on page 18, if you will. You'll see a table on page 18 that shows the yield to maturity. It just says yield, but it's the yield to maturity of the overall portfolio. In the table is 4.56. The benchmark comparable yield is 440. And so that's more of a market-based yield. It takes into account, when you're talking yield to maturity, everything about a bond portfolio. It includes the premiums and the discounts on all the bonds as well as their coupons. I think where the confusion might have come, and again, I'll kind of let you all tell me for sure, but in the appraisal, when you get into the page 24, for example, you'll see something called current yield. And those yields are a lot different and are influenced by what the actual coupons are. And so if you've got a bond that's got a 0 coupon or a real low coupon, it doesn't show up. And so the overall current yield on the bond portfolio, part of the portfolio, is not very useful. Now, when you talk about stocks, which are at the bottom of this appraisal several pages later, current yield is a little more accurate in terms of reflecting what the contribution is from a stock, but it's a lot less helpful on bonds. Now, we put it in here so that it's part of the formatting of the appraisal, and unfortunately, the way those formulas work, it just takes the last payment and divides it by the price of the bond or the price of the fund. And so, I don't have one here, but let's say a mutual fund, like an equity mutual fund, might pay its dividend in December. Well, it's going to annualize that as if it's always going to pay that dividend, but those can be quite different year in and year out. And, so I guess the gist of the story here is the yield to maturity is a far better representation of what the bond portfolio is doing and what can do over the next 12 months. The current yield is sort of just do some information. It's really, you got to take it with a grain of salt and look at what it's telling you. So like if you think of a T-bill, the T-bills right now, they yield 5%. Well, T-bill doesn't have a coupon. It's just you buy it below par, and it would have a 0 current yield. So that's part of the mismatch going on inside of a bond portfolio, and unfortunately that's just something you got to look through and know. So I can see where there could be questions about the current yield and the yield to maturity and how they're different. Does that help, Jeff?
Yeah, the explanation you guys had sent to Ed before. Yep, it was great just to clarify where, how the number on page 18 was calculated, so, yep, perfect.
So Woody, basically, you can calculate yield different ways, and the yield to maturity is kind of the generally accepted way of looking at what a bond portfolio is yielding. And as you said, the current yield is it's just a different calculation. It's not showing the same thing. So there's really not a comparison there. They each tell you different information.
Yeah, I would say the reason you can't add current yield to yield to maturity and have, it's like apples and oranges. So in a appraisal, the people who put the appraisal together want the bonds to sort of sing the same tune as the stocks. And it just doesn't fit well, but that's what they do. And the current yield on the whole portfolio is what it is, but the yield of maturity is a far better reflection of what that bond portion is really doing.
Yeah, unfortunately, it's a deficiency of our report that we don't have yield to maturity as a column. We have, as you can see, if you go to page 24, we have a current yield column and an estimated annual income. But I think it's probably best to probably kind of ignore that because when you get into fixed income, there's just a lot of kind of noise here that kind of misrepresents the current or the yield to maturity, which, as Troy said, is the true number. So it's, yeah, I mean, we've dealt with this for a long time. I think we have what we think is one of the best reporting systems out there, but they just have a hard time picking it up. I guess what we could do is take those columns out of our client reports, but then some clients like to think, well, what's the yield on these stocks? So it's really more stock oriented than it is fixed income oriented. But it's just it's a shortcoming of this report in terms of that column.
I don't think that's not, I mean, from my point of view, I don't want to speak for all the board members, but I don't think that's necessary. It was really just a clarification on what was being represented on page 18, different than, the current yields that were reported in the back. So, nope, you guys clarified it. Appreciate it.
Yeah. Okay. Well, good. Well, let's go back to page 13 because we'll take a few moments and talk about international investing out in companies outside of the U.S. And this has been kind of a staple of most investment policy statements for endowments, foundations, pension funds, and individuals for probably going on 40 years now, 30 years, because I think the idea is more diversification is better than less. And over long periods of time, there's a cycle where foreign markets will do better than the U.S. market, and then it switches, and these cycles can last up to 10 or 15 years. And the benefit of some diversification is sometimes, we've been through a golden period for the U.S. economy relative to countries outside of the U.S., but it hasn't always been that way. And then on top of it, you get U.S. dollar, the exchange rate, and if the dollar was to go through a significant decline, it would make foreign stocks, look more attractive. And so there's a lot of good reasons why you want to have an allocation to foreign companies. But as page 13 will show you, it's been a very poor, difficult, possibly embarrassing time because foreign markets have significantly underperformed the S&P 500. And you can see if you go back 10 years, this MSCI ACWI, that stands for Morgan Stanley Capital International All Country World Index, taking out the U.S. So it's basically pretty much all public companies outside of the U.S. And that performance, well, if you go back 10 years, you can see where you have a return probably over a 10-year period where whatever you started with, you might have twice as much in the U.S. market than you do now in the foreign market. And what I'm doing there is you take the 12 minus 3.8, that's 8, that's about 8.2. The rule of 72, that's probably I'm getting too much under the hood. Jeff probably knows what the rule, and Ed knows what the rule of 72. That just means that 7.2% money doubles over a 10-year period. And so this would suggest that, S&P 500 is made way better returns. I mean, doubled what the foreign markets have done. And so we've let the foreign exposure dwindle a little bit over time. And you might ask, well, why would you want to have money over there if it's underperforming? Well, over long periods of time, this is a cycle that kind of reverses itself. Foreign markets do very well for a long period of time, and then it switches. And there's all kinds of geopolitical reasons for that in the dollar. But if you go, to the next page, which is a common measure of the value, of the inherent value of a company, of your investment, is the price earnings ratio. And that's basically the price of the value of a stock divided by its net profits over the last year. And when price earnings ratios are very high, that's typically an indicator that something is overvalued, and it may not, I would underscore, may not perform as well over the next 10 years. That's what history would show. That's actually factual over long periods of time when you take overall markets. But you can see here that going back over 20 years, that the price earnings ratio of U.S. stocks and international stocks up until about 2012 or 13 pretty much were about the same. And then they started to gap out. And now you have the difference between the price earnings ratio of companies in the Standard & Poor's 500. Sorry about that. And the difference between the price earnings ratio of the Standard & Poor's 500 versus the foreign market, I dare say it's about as wide as it's ever been. Even if you went back another 20 years, back to, let's say, 82, it's extremely wide, which would suggest that this thing is going to snap back and foreign stocks will do better. Maybe we're in a different environment, and U.S. companies, for whatever reason, the U.S. has a better business environment, this will continue to be the case. But when you look at our performance, and when we get back to that page in a few moments, you'll see that it's been kind of a drag. The good news is we have a limited exposure there, and we'll look at that in a moment too. But the next page is just basically a derivative of this page we're looking at, which is if you created a ratio between the U.S. stock PE and the foreign stock PE, you can see how this relationship now is, like 1.5, 1.6. So you're paying, 60% more for the average stock in the U.S. than you are for the foreign stocks. So I think this is a little bit of a lesson in asset allocation. It's a lesson in valuation disparities. It's kind of a lesson in the shortcomings sometimes of diversification. But there's a lot of people out there that say, hey, this has gotten to be an extreme, and don't sell foreign stocks short because this is likely to revert to the mean, and which means foreign stocks could do a lot better over a period of time. If you go skip ahead, you'll see to page 17, you'll see that foreign stocks are about probably, maybe 9% of all the stocks. We have, if you add 61.5 in domestic and the 5.9, that's 67.4, and that in foreign is 5.9. So about 8% of our stocks in foreign stocks. That actually, relative to many endowments and foundations, in other words, portfolios like yours or organizations like yours, I would say that's a little bit on the low side. Having served on quite a few of these boards myself, I would say that's, at the low end, it's probably more frequently around maybe 15 or 20. Anyway, so a lot of information there. I'll turn it back to you guys and let, ask some questions or, answer your questions.
Anybody have any?
So I think it's been good that we're lower than the norm if the returns have been lagging for that long. Like you say, that could switch at some point.
Yeah, I mean, I wouldn't be surprised if 5 years from now there'll be questions like, well, how come you guys were only 8% in foreign stocks? Because, now all of a sudden they've snapped back. It's an interesting dilemma, but there's also a study that was done recently by Morningstar that lined up companies in the U.S. versus counterparts in, let's say, Europe. And you looked at industry by industry, for example, pharmaceuticals, or consumer staples companies like Procter & Gamble versus Unilever. And what they found was that U.S. companies on average are actually, in recent years, much better companies. In other words, they have higher return on shareholder capital, better profit margins, better balance sheets. In other words, they have, stronger balance sheets. They manage their money better. They have more free cash flow. So that might suggest that, well, the reason you don't want a whole lot in foreign is those companies just aren't the same or as good. And I think you could speculate on why that is. It could be that, outside of the U.S., particularly in Europe, you have a lot of social programs, regulatory issues. In Germany, for example, every public company has to have several labor representatives on the board. And, you take all those things together, and it may be that European companies are not, they're just not operating in a good environment, and that's why they don't, the companies aren't managed as well. Any questions or thoughts?
No?
No.
Is this kind of subject helpful in terms of our meeting, or is this maybe too much detail, too much under the hood, maybe too complex? Give us some feedback as to whether this kind of topic is of interest to all of you.
It's of interest to me. I asked for it to be included, so.
I
think it's interesting.
I personally like it. I mean, for my perspective, I agree with you guys. We underweight, not this is about what we do with my clients, but we also have low international exposure. I really feel like over the last 30 years, part of it was that whole diversification and exposure to other markets that you couldn't get with U.S. companies was kind of original idea. But, now that S&P 500 companies get, anywhere from 40 to 60% of their earnings overseas, you have that exposure through, U.S. companies. So, I start to wonder, this is just me personally, like, what does it mean to have international exposure? Because you're measuring your exposure to companies domiciled outside the U.S. It's not really how much of the activity is taking place internationally, because we're more of a global society, global today. So anyways, neither here nor there, but I like the lower exposure for all the reasons you guys indicated.
It's akin to buying an American-made car. What is that?
Yeah, exactly.
And I
And
think,
I
like-
hate to say it, you guys, I have like 5 minutes and I have to run. I have a 10 o'clock appointment. So if there's something we need to vote on,
There is.
yeah. I don't mean to cut this short, but
All right.
So Woody, I think the takeaway is a deep dive or moderate dive into some topic like each quarter is probably, we can try that for a while if there's stuff that's kind of interesting, just to keep it fresh.
Yeah. No, we love talking about this. This is what, we talk among ourselves about all this stuff, so we'd love to share it. I mean, this is what gets us excited, these topics. I think I heard Jeff maybe on a short timeline, but I think the rest of this report, we can maybe hit some high points. Is that okay, Ed?
Yeah.
Okay, so on page 17, you can see we're right about 13 million. It's showing that we're a little overweight on equities, 67.4 versus a target of 65. Well, we made a change a couple weeks ago, and that's now down to about 65. So that's we're right about at the target of the investment policy statement. I'll let Troy maybe take 30 seconds on the bond page.
Yeah, we've already touched on this a little bit, but the point of the graphs are just to show the diversification and how the bonds are positioned. First, the table, the average maturity is a little over 4 years, and the yield is about 4.56, and A+ credit quality, which is quite high. The maturity distribution to the left there spreads out to 10 years. With an emphasis on bonds that mature inside of 5 years, if you'll notice what's in the green. What are your popular sports?
Well,
and then lower left there, you'll see that corporate bonds, where we tend to find more yield advantage, have one of the biggest weights in the portfolio. And the other areas there that we like the mortgages. The treasuries are kind of an anchor, and there, should we get that unexpected slowdown in the economy and have a recession at some point, the treasuries would be expected to be some of the better performers and provide diversification, certainly against the equity portfolio. And then to the lower right there, you see the credit distribution.
Next page just shows how you're diversified among these 11 Standard & Poor's industry groups. Those are under the left-hand column there. And, we're a little light on technology stocks, but overall, we kind of reflect a widely diversified portfolio, somewhat in line with the Standard & Poor's 500. Next couple pages is the cash flow going back to 2000 with the fund. I don't know, Ed, did you want to say anything about this page?
Well, no, I think it's pretty self-explanatory. We've gone through it and made sure everything is ticks and ties and is accurate, but we're going to be talking about the spending roll calculation here in a minute, so we'll just go to that.
Okay, well, it's good to see, going back, starting in 2011, about 320 grand per year, and you're up to about 433. That's a pretty good increase. And then really the last page is the performance, page 22. And last year we were up 15.6 and 15.1 after fees. And you can go back over the 10-year period, and we have all these comparisons here. I think that's about it for us.
Well, thanks,
Happy to answer.
Troy and Woody. That was helpful. We're going to move on, I think, so we can get the meeting over and everybody can get to where they need to go.
Thanks, Woody.
Thanks, you guys.
Appreciate it.
Thank you. Pleasure to be of service. We'll sign off, I guess, yeah.
All right.
Okay, thanks, everyone. Have a good weekend.
Are you doing the
Are we just
spending?
confirming the spending rule, or are we trying to adjust it?
No, it's just to recommend this number to the city for the budget.
Just following what it is now.
The
Yeah,
3.5%?
this will go into effect July 1 of 2024 through June 30th of 2025.
I'll make the motion to recommend the current 3.5%.
I support.
So my only
Aye.
comment is
Oh.
because of the way the portfolio is designed, that number tends to grow even though we've lowered that percentage. So we're still having more funds for city initiatives and the portfolio is continuing to grow and maintain its purchasing power. So it's doing as it was designed.
We're being good stewards.
Yeah.
Yeah.
Any other comments?
All in favor?
Aye.
Opposed? Okay, motion carried.
Do you need me for the rest?
I just got one change on the bylaws. I don't know if we need to vote on that, if I got it real quick.
Now's the time,
So
yeah.
just section 6, it says the mayor is automatically the chair, the finance director is automatically the vice chair. If a member of the board, I think it should be switched to the finance director is automatically a member of the board. Like that doesn't make sense to me that if it's a member.
So just the finance director is a member of the
Yes,
board?
automatically, yes.
Does it have to have readings for it or not?
You need a motion? for that?
Yeah.
Take out the not is basically,
I'll move.
I think in one of the ordinances, I'd have to look at this, I'm not sure. I think it specifies something about the finance director being the trustee. And we'd have to look at the ordinance to see.
It's just the way
It does
that-
say that you're a trustee. I think what she's saying is just that you are a member of this board.
That would make it consistent with the ordinance, I think. Right?
Probably.
Yeah.
It's just the way that this words, it says the mayor shall, with the approval of the city council, appoint two either elected or appointed officials. It should be on the first line with the mayor. It should be the finance director is automatically a member, so it's not worded differently. So if somebody else is sitting in the spot, they're like, I don't want the finance director here.
So is there is there a support?
Yep.
Doug made the motion. I don't have support yet, I don't think.
So so we're just talking about section 6 to
Yes.
change.
I'll support.
All in favor?
Aye.
Aye.
Opposed?
Not a
Okay.
Am I explaining that correctly, Ed? So you,
So you'd
Thanks,
say, are you saying, so it'd say the city finance director is automatically the vice chair, period, and then would you strike the sentence after that as well?
yes.
Okay.
the whole sentence, okay.
Yes,
not
because
just-
the way that I'm reading it, if somebody else is sitting here, they pick the two, the way that, B reads, the mayor shall appoint,
Just take it.
on approval of city council, appoint two either elected or appointed officials. So it could be a council member or two council, it could be somebody else besides you. I think that it should automatically be the
No.
financial director.
Take out that whole sentence.
Yeah.
Yeah, section 6, it should just say the mayor and financial director are automatically members, chair and vice chair.
And then we start back up, recording secretary services will be provided by the executive
Yes.
secretary. Okay.
Okay. And then were there no changes on the roster?
No, I didn't have any. Can we just keep going? Okay, so we have no public comment, so motion to adjourn. If nobody else has anything.
So moved.